Welcome everyone. Thank you so much for coming on and joining us for this chat. Thank you, Sanjeev, for joining us as a panelist here, especially in a busy time. Last month we focused in on doing a webinar for landlords on how to deal with tenants during this pandemic and policies that were put in place that you can no longer evict for non-payment of rent. And that caused a lot of panic in the markets wise, a lot of misinformation to tenants. So we spent April dealing with that. Another byproduct, and if you're interested in watching that, those are available on our YouTube channel, on our website. You can look at those. Another byproduct of this whole pandemic has been the tax season. That has changed. So typically the deadline to file your returns as a personal individual was April 30th. Now that has been extended to June 1st. So we had great feedback from our webinars in April. So I decided to bring Sanjeev on, a friend, investor, and also does accounting work for us, and has allowed myself to significantly grow my portfolio. As we wanted to bring him on and let people know how you can really maximize your wealth and minimize your tax as a real estate investor. There are many things from the basic level to the more complex level that you can do things to really increase your wealth. And it just takes the right professional. And I will say this: the right professional, and also the professional that is in bed with you. And what I mean by that, Sanjeev is also a real estate investor and also has invested in condos. So you may go to an accountant and want to do certain things, but that accountant may not have the expertise or the know-how to deal with the transaction in the proper way and set up the proper structures. This is why I wanted to bring Sanjeev in, because he knows specifically what needs to be done, because this is something he does himself. And he's been in the business. How long have you been accounting for? 35 years?
Yeah, almost.
Yeah, 35 years.
Exactly 35.
Oh, pardon?
Exactly 35 today.
Exactly 35
today.
And it's a family business. His son is with him as well in the business wise, and he is passionate for it. And yeah, so you have continuity with that. So for those that don't know me, my name's Alex Wilson. I am team lead for AlexJWilson.com and a broker owner of REMAX Wealth Builders Real Estate. And below us, we have our director of operations and sales representative, Kyle Dovigi.
Hi, everyone.
Hey, he's going to be moderating everyone. So if you have any questions today, I have questions for Sanjeev. I'm going to ask him those. We're going to keep it discussion based wise. And then we'll open it up to the floor for questions. So there is a question and answer section in the platform. Ask the questions there, and then we'll go through our questions once we're done our discussion wise. So Sanjeev, do you want to give some background on yourself before I start asking you some questions?
Okay, good morning. As Alex said, I've been in profession for almost 35 years now. So I love this profession more than anything else.
And you know what, and what I'll also add, you're passionate about accounting, you're passionate about real estate, but also what I found is that you can communicate very well with the client. You're not going to overwhelm them with complex scenarios. You're able to translate that into a layman's term where people can understand what you're talking about, and you'll work with them to achieve their goals, as opposed to someone telling someone something and they're looking at a blank face. You're not, I don't consider you the typical accountant, demeanor wise, that kind of.
You're not the first one, and you won't be the last one. My son was the first one who said, "Daddy, you're not an accountant, you're a businessman." Yeah.
And I really want to let everyone know on the call, like if you deal with Sanjeev, you'll notice a difference than dealing with any other accountant.
You know what, Alex? I see some questions on my right-hand side.
Mm-hmm.
So I see Gary asking a question regarding Scotiabank,
mm-hmm.
where he says the investment property is drawn on from the HELOC.
Mm-hmm.
Gary is right. Banks are typically not allowing HELOC to be used as a down payment for the purpose of purchase of any property. Rather, I saw CIBC in the last week itself. They are trying to curtail as much as they can on HELOCs. The message which I get from this is a mixed message now. If the big banks are looking at it, that they do not want the HELOC to be used as a down payment of the properties, it means internally they're well aware that there's going to be a boom. And from the back end, there are strings being pulled up that not to allow this boom to go out of hands by not, the only way to do it is lack of liquidity. They're not allowing them to use these funds. Having said that, there are people who already have HELOCs. And the question is whether they can use that HELOC or not. On a plain word, the answer is no. In a smart way, the answer is yes.
Well, and, you know what? Let's bring it back to that later on, and when we can talk about these different strategies wise, and we'll let everyone know we are going to be doing these for the month of May on Fridays at 11 a.m. So there will be different topics that are explored. Some always when people ask questions wise, that's creativity comes out and answers get answered. But I'm going to start off easy wise. So a little softball. I own an investment condo. You know, what type of expenses can I claim on my tax return with my
typically, of course, the general, of course, the condo fees, the property tax, or repairs, maintenance, interest, any other associated expenses with the property, whatever. Sometimes you pay utilities, insurance. Those are kind of expenses you can claim. But the other expenses, apart from that, which you can claim it depends upon the size of a portfolio you have.
Yeah.
Let us say you have 10 condos, just for example's sake. Depending upon your income size, what we will typically do is move that income into a corporation through a management fee. So the personal income goes down lower. We are still paying taxes into the corporation because that becomes an active business. But there are things which you have to be very careful while you do so. Because tax typically, I think most of us will have between 45 and 53%, most of us. That's what I believe. Where on the corporation side is 13%, you straight away save about 30% in taxes.
Yeah, which is big. It's massive.
Which is massive. It is not saving of taxes. I would say deferring of taxes, because at the end of the day, when you take out money from the corporation, there are going to be taxes. But I would say if we are able to defer the taxes for a typically long term and use that kind of money to build up your portfolio, that would be a great thing.
Exactly. And here's what it comes down to is that cash flow is great. But if you're at that rate if you're at that 43 to 54% tax rate, your cash flow is just getting taxed away. And realistically, you probably currently don't need that cash flow to live right now. So speaking about strategies wise and growing portfolios, if you're able to increase the interest expense on your portfolio wise, you're going to reduce your cash flow. But by increasing the interest expense and then going investing in other properties wise, you're actually increasing the spread of your portfolio. So down the road, when you actually wanted to tap into your portfolio wise and live off some of your portfolio, you have more pieces to live off of versus, let's say, the 1 to 2. You can have a spread of, as Sanjeev said, 5, 10, 15 properties wise. By reducing cash flow, but increasing the portfolio, it's really just it's Monopoly. You're playing real life Monopoly. You're starting on Baltic Avenue and then moving your way around the board till you get to Park Place. So that's what, when you get into these strategies wise, you can actually do this. This is fully achievable. My next,
I would add on here, let us say you have multiple properties, because I do know people who have about between 10 to 25 or 30 properties. That's kind of clientele I have. We ask them to maintain a logbook for the visits they make to various properties at various points of time during the year. And by doing that, I know the tax advantage is going to be little, but it'll be a lot of money.
Mm-hmm.
You can claim mileage based on the mileage rate
Mm-hmm.
as an expense there.
Mm-hmm.
Because mileage is about 52, 53 cents a kilometer.
Mm-hmm.
That money, if you put it as an expense, it is not taxable.
Mm-hmm.
Because technically it's a reimbursement of expense.
Yeah.
And the cost of mileage is far more lower. The cost of mileage is about 15, 20 cents.
Mm-hmm.
So you take away out the extra money
Mm-hmm.
without paying any taxes.
Yeah. And those are different things that people.
Those are different things you can do.
Yeah.
But on the flip side of it, let us say people have large portfolio, maybe 5, 10, 20 properties, but they have a fairly large active business income on their personal side as well.
Mm-hmm.
In that case, I would recommend them to do the rollover under Section 85 to a corporation.
Mm-hmm.
Because having the properties in a holding company will allow them to defer their taxes over the long term and plan their taxes over the long term. Typically, on a real estate, you would say the taxes are close to 50 to 53%, but a bulk of the tax comes back if it is distributed as a dividend. So there's a lot of planning involved there.
Yeah. Yeah.
It is person to person. What applies to me, it doesn't necessarily mean it is going to apply to you as well.
Yes. Yeah. It definitely takes a conversation.
Do not take my word for word. It is based on a lot of assumptions behind the things.
Yeah. Now my next question is, so there are going to be people on here that are just as they have the 1 or 2 properties. You can write off your typical things, as Sanjeev said. You can write off some additional items as well if it relates to the property, even if you have 1 or 2. And if you're driving to the property wise and everything like that, there are different things you can do to look at writing off those expenses.
And Alex, I think we should clarify that really you're able to write off anything that is directly related to
the property.
Yes.
Right?
Yeah.
That includes things like legal fees, the commission that you have to pay to rent. Anything that's directly related is an eligible expense.
Any expense which is related to generating the income from that property is a write-off.
Yeah.
It is similar like to a business.
Mm-hmm.
Any money spent to earn that money is a write-off.
Yeah.
But we have to be very careful in crossing the lines. It's a very thin line between all the things.
Yeah, exactly. If you go, you can't write off your vacation to Miami.
No.
Just to give people an extreme example why. Within reason, you can. And there's definitely a line you need to follow wise. Now, speaking of that,
Generally people miss one thing, which I've observed, I would say 75% of the 100 cases.
Mm-hmm.
There are most of the people use their HELOC to buy any investment property.
Mm-hmm. Mm-hmm.
And they forget to write off the HELOC interest on that rental.
Yep.
So this is one thing people miss. I would say always make a note.
Mm-hmm.
Don't miss on that.
No, of course that interest. So yeah, the home equity line of credits that you use to buy your investment properties, that interest is complete. You can write that off.
Yeah.
Well, and some people don't know this, and because we're experience wise, we take it for granted. The interest on the property, on the mortgage wise, is you can write that off. And I say that because some people are surprised you can do that, but interest is an expense. And if you're using other people's money, which you're paying interest out on to generate income, that interest can be fully written off against the income.
You cannot write off the principal. Right.
No, sir.
You can't write off the principal. No.
Principal is not an expense.
No, principal is not an expense. So that is the taxable portion. Now,
so what about expenses like using your home or your phone, computer, that sort of stuff, where it's not?
You know what? It is very difficult. It is very difficult to really work on those expenses and to back it up. It is going to be very, very little. I generally won't like to go for little things, which are harder to explain, because let us say if there is a CRA clarification on that, you'll be paying more to your accountant to provide a clarification than the expense amount. So better not do it.
Yeah. Here we go. Do you recommend depreciating your investment property?
A wonderful question.
Mm-hmm.
You can depreciate the property. There is no bar to that. Mm-hmm. But you cannot claim a depreciation to create a loss. Mm-hmm. Because the depreciation is restricted to the maximum amount available before writing off the depreciation. Mm-hmm. Let us say the net income is $5,000 and depreciation is $6,000. you'll be allowed to write off only 5.
Mm-hmm.
But
Mm-hmm.
now the catch is when you sell the property,
Mm-hmm. Yeah.
let us say the property value was $500,000, and by the time you sold it, you have claimed over $50,000 in depreciation.
Yeah, it's recapture.
The depreciation would be recaptured and would be added into your income.
Mm-hmm. Mm-hmm.
And you won't get a capital gains deduction there.
Mm-hmm.
It'll be just like an ordinary income of $50,000.
Mm-hmm. Mm-hmm.
So it might be possible you end up paying higher amount of taxes.
Mm-hmm.
But generally what I recommend people is that if you're buying properties for the long term,
Mm-hmm.
it means by the time you come to the sale of the properties, you won't have active income.
Mm-hmm. Mm-hmm.
When you won't have active income, it means the recapture is going to be a lower amount, you'll pay lower taxes.
Mm-hmm.
Right now, the taxes might be 45, 40, 53%, but in future, the taxes might be close to 30%.
Mm-hmm. Mm-hmm.
So you not only save taxes over the long term,
Mm-hmm.
but you also generate income over the money saved from there.
Mm-hmm. Mm-hmm.
So it's, as I said, it depends upon the age of a person,
Mm-hmm.
the time you want to hold the property,
Mm-hmm.
and last but not the least, what is the expected income you might have when you sell the property?
Yep. Yep. Of course. Yeah. All different variables that come into play. And that's the beauty of tax wise. It's like a snowflake. No, every person.
It is so much. Over the last 35 years, I've been reading books and journals. I feel I'm not missing on everything.
Mm-hmm.
Every day is something new.
Mm-hmm. Mm-hmm. So I like this question. What taxes are applicable when I sell a property, and how do I reduce those? And then I will add, do you recommend selling?
First of all, I don't recommend selling.
Yeah.
Let's put it. But yes, there comes a point when we have to sell.
Mm-hmm. Mm-hmm. Mm-hmm.
But now coming back to the fact, when we sell the properties,
Mm-hmm.
how do we reduce our taxes?
Mm-hmm.
A lot will depend upon the personal income of a person.
Mm-hmm.
I can give you a scenario here. We had a client with about more than $250,000 in income.
Mm-hmm.
And he wasn't expecting to have bigger income in the coming years.
Mm-hmm.
What we recommended him was, okay, you know what? Transfer your real estate into the holding company when we have to sell the properties 1 or 2 years before.
Mm-hmm.
We transferred the asset into the holding company. When you sell the asset into the holding company and you sell the property within the holding company, the capital gains are exactly going to be what you have there. But the beauty is 38% of those taxes paid are refundable taxes. When you distribute that income as a dividend from the company to the personal side, you can plan to pay off the dividends from the company when you don't have more income on the personal side and take that money back. So if you distribute, let us say $100,000, you will still get $33,000 back from CRA, because that is the amount that is called as refundable dividend tax on an RDTUH. It sits into your account. Though you paid 53%, that portion still sits in your account. You can get that money back when you distribute as a dividend to the extent of 1/3 of the dividend paid. So the numbers have to be planned based on your income for each year. Usually, husband and wife are both partners. Mm-hmm. If you give 100,000 to one, the tax is about 27,000. But if you give it between the two, the tax is going to be fairly very, very low, close to I think the 2,000 or 3,000 each, and you still get that $33,000 back from CRA. Mm-hmm. One more thing: when you distribute the income from your corporation, which is generated through capital gains, 50% of that income is also tax-free on the personal side. Mm-hmm. That's how the tax integration works. Mm-hmm. So you can still take out that money tax-free. Mm-hmm. So you're not losing on taxes, but you'll be gaining on the cash flow over the medium and the long term.
Yeah. Yeah.
But again, question would be how you plan your income.
Exactly. Yeah. It all needs to be planned out and sitting down and again, when you can, a lot of the stuff you can put into an Excel spreadsheet and then show people, and then you map it out and go, here's where it is. And then you show the net savings to people and explain that to them wise. it's really
99 out of 100 people have gained on this.
yeah. Oh yeah. Yeah, exactly. And these structures are available for people to do within the country of Canada wise.
This is perfectly legit.
Yeah, exactly. Yeah.
We are nothing, I would say we are in the gray area. We are exactly within the portfolio of the taxes. They allow us to do it. But yes, it's planning.
Yeah, it's all planning.
It's not tax evasion. It's
yeah,
planning.
no. That's what I want to. Yeah. No, guys.
No, I mean very specific.
Completely. It's all planning wise, and it's not. Well, that's what it is. It's planning wise, and it's not. If you're going to pay the tax, it's when you're going to pay the tax. You always have to pay the tax. The tax never cometh. It's structuring when that tax is going to come out and making sure it's coming out at the right time. I just thought of a great analogy wise. With electricity wise, we have peak periods and we have low periods. If I use electricity during the day, the hydro companies are going to charge me more because that's when they're peak usage wise. But if I did my wash at night, I'm going to pay less on my electricity. Same thing at tax wise. You take the money now, they're going to charge you more. But if you have the ability to structure it in a different way when you can take that money at a later date, which would then be tax advantageous to you.
Sanjeev, are there any general rules of thumb for when it is beneficial to set up a holding company? Say a certain threshold of income or a certain number of properties?
I would usually say when you are crossing a limit of $100,000 in net income, usually I would say the benefits start creeping in. But they max at 225.
Great. And how much does it cost to set up a holding company usually?
The cost to set up a holding company is not big. It's about close to maybe $1,100 or so. If you go to any lawyer, that's the amount you should be taking, $1,100, $1,200. They would do that for you. And always go to a lawyer to incorporate a corporation. I would say here, though you can go online and incorporate it, but if you miss some things into the corporation, they impact you in a big way in future.
Yeah, you really need this set up correctly wise, and this is not the time to skimp out. And I will also add, you want to make sure you're going to a lawyer that knows what they're doing wise for the correct ownership structure. And this is actually where you have to do it with a lawyer and an accountant at the same time, because the lawyer is the one that's going to set up the holding company and the legalities around it and the share ownership distribution and everything like that. So you need the lawyer. But you need the accountant to give you the advice how to properly set up the ownership structure to the taxable way. So you have to make sure you do it the right way to make sure that it's tax advantageous to you. It's easy to do it. It's very easy to do it the wrong way. So that's where it's not only do you want to bring the lawyer in and the accountant in, you need to bring the right lawyer in and the right accountant in. Very, very, very important wise. And you know what? This brings me a great topic. I'm talking about that because people do this and I've seen it. Sanjeev, do you buy a piece of real estate in your operating company?
Never.
That's
never.
Big no-no.
It's a big no-no. Never ever do that, because what happens is, the simple reason for that is when you have an operating corporation, you're dealing with people and you're exposed. There's a high risk. I do something wrong, somebody comes back and sues my corporation, I'm done. There's so much there. The operating corporation should be the poorest corporation in the world for anybody. There should be nothing. The money in the corporation should be equal to 3 months of your expenses. That's what I've always done throughout my life.
And on top of that, we promote the use of leverage wise to grow your portfolios. You're not going to be able to get a mortgage on your property if it's in the operating company. Banks, as Sanjeev said,
banks don't like it.
No, because there's the reason. There's a risk associated wise. Banks are risk adverse. They will not give you a mortgage on a property in the operating company.
The smaller size might be okay, but when you're coming to a bigger ones, they say, no, get onto a holding company.
Yep.
We need a holding corporation. That's what they like to do. They even like to do is, let us say you bought a property for $4 million. They say set up new holding companies for all the bigger properties separately. because they have a high risk on each of the properties otherwise.
Yeah, yeah. And
on the tax side, nothing changes. On the funding side or the mortgage side, nothing changes.
Yep.
But the risk which goes down with setting up of the properties under separate holding corporations.
Yep. And again, for the people that are new to all this, it's not that complicated. It's really not that complicated. There is an ongoing cost, which you are going to have to do corporate tax returns and everything like that. But I will tell you, it's not that complicated wise, and the vast advantages outweigh significantly the cost wise, and it really doesn't add that much work extra to your plate wise once you get that initial setup and everything done.
It's not your work. It's the work of the accountant. Let him do it.
Yeah, exactly. Yeah. Just
make it his problem.
Yes, there you go.
Sanjeev, if you own properties personally right now, you don't have them in a holding company, can you move them into a holding company in the future?
Yes, we can move them into the holding company. There's a provision in income tax, which is called as Section 85. Section 85 allows you to roll the personal properties into the holding company tax-free. Let me explain you here. There are two kinds of transfer here. One is a paper transfer, one is a legal transfer. Legal transfer means that you want to move the title of the property into the holding corporation as well. When you do that, of course, then you need a lawyer. And there are conflicting opinions on this from various lawyers. Some people have tried to move the properties tax-free. So, paying no land transfer tax. And some have said otherwise. So I'm not an expert on this. I will leave it to that lawyer to decide what he wants to do. So going back to the other thing, we were talking paper transfer and legal transfer. When you do a paper transfer, all what is required is the accountant has to draft all the legal paperwork and inform CRA that this property on paper has been moved to the holding company. With right from that date, you're supposed to report all the income and expenses for the properties within the holding company, not on the personal side. On the flip side of it, the mortgage will still keep on running in your own personal name. You don't have to change it then. Because the bank will only allow the transfer of the mortgage into the holding company if you make a legal transfer. But unfortunately, the legal ownership still stays with your own name. But if you decide to make a legal transfer, then there are two steps involved. One, a lawyer, and second is the bank.
So then, my next question is: I think we've covered what a holding company is. I'll just give a quick little layman answer. Holding company is just a company that's going to hold your real estate assets. That's it. And then going into structures wise, I'll ask this question, then we'll get into that. Does it make sense for me to own my condos? Does it make sense for me to hold my condos, my condo investments in a holding company? And we've touched on that, but we'll get deeper to the answer. But I put in brackets for myself wise. If you are self-employed, if you're self-employed, the answer is almost always yes. So why don't we answer the question, if I'm self-employed, Sanjeev, and I surpass a certain income threshold, why does it almost always make sense for me to own my condos in a holding company?
First of all, risk. Because the condos are held by a person on the corporate side, you're not exposed. Mm-hmm. Since you're running the business in your own name, you're always exposed towards your clients. Mm-hmm. So the exposure goes down. Number two, tax-wise, it won't make a huge difference whether it's a holding company or it is the personal side. It won't make a huge difference. But it will make a huge difference when you distribute that income and how you distribute it. Because let us say, Alex, you made more than 250 this year. Mm-hmm. Next year, you again made more than 250. But in the third year, you almost were close to 30,000. Mm-hmm. But on the property side, you made a money, and the holding company, the money is still sitting there. Mm-hmm. Let us assume there's $100,000 sitting there. Mm-hmm. and you want to move the money out because you need it for your home this year.
Mm-hmm.
When you take that money out, and if it is a tax paid money, CRA will pay back $33,000 to your corporation. And on the personal side, 50,000 might be added to you, or 50,000 might be added to your spouse. And the tax, as a layman, I would say will be close to $7,000 on that.
And I'll explain to people. I think we skipped a step here. The key thing is how money got into the holding company. So you have the operating company. So in Sanjeev's example, let's say I need $250,000 a year to run my family wise, everything like that. But I made $300,000 that year. What I can do with the holding company is, instead of paying myself $350,000 and paying the higher tax rate, I can move that $100,000 from the operating company to the holding company and then use that as my investment funds. Correct?
Yes. And that there's one thing I think I missed out.
Yeah.
When you move the money, when you move your asset from your personal side into the holding company, and you have an operating company as well, it's a very smart thing now to remove money tax-free. Since you paid some part of the money as a down money already, let us say the property was $500,000 and you paid $200,000 and $300,000 is a mortgage. So technically it means the company is supposed to pay you $200,000. If you move the money from the operating company to the holding company, and from the holding company you took out the $200,000, that was a company which paid you against the debt. It's non-taxable. So you remove the money from the operating company in a way there's no taxes. So it's just a planning.
Yeah, and it's all 100% planning, because I'll go back to the people. Remember, you initially paid all that money out of your pocket wise. So again, we're just structuring how the money gets back to you, and at certain periods how it gets back to you.
Because money moved from the operating corporation to the holding corporation is non-taxable.
Yeah, correct.
So there is no tax involved there. When the debt is paid back by the holding company to you personally, there's no taxes, because that's not income.
Yeah, and that's one of the. So that's why on the self-employed side, when you have these operating companies, the answer is almost always yes to have your assets owned in your.
No questions asked.
Yeah, it's not. And unless you're broke, then it wouldn't make sense. But other than that, yeah.
We've gotten quite a few questions around this. What is a holding company versus operating company? What does each mean?
Oh, great, perfect. Okay, there we go.
A beautiful question.
Yeah.
In the articles of the holding company, the object is clearly defined that it would not run any active business. It stops you from doing any other work within the company apart from holding an asset.
So does it have to be just real estate then?
Real estate, investments, some people hold stocks and bonds through the holding companies. Some people hold their cash through the holding company. It depends. It's when you say holding any kind of asset.
Yeah.
Other than active business.
Yeah, and I think the easiest way to think of it, your operating company is what you make your day-to-day income in. That's your business. That's your business. I own a real estate business. I make my money transacting in real estate. Sanjeev owns an accounting business. He makes his money by doing taxes, accounting work, consulting work, everything like that. That's how we make our money day to day. And then the holding company is we're able to move money from the operating company to the holding company. We don't do any billing from our holding company. We're just holding our assets, as Sanjeev, whether it's cash, stock, or real estate in the holding company. Now, you don't want to hold stock and real estate in the same holding company. We're not getting into that, but that's what the two definitions is. The holding company is sitting there holding an asset. The operating company is what you make your day-to-day money in.
I would always recommend real estate in one corporation, investments in the other corporation.
Yeah.
I don't want anybody to touch my liquid fund because that's my lifelong. Everything can go bust. At least the cash still remains.
Yeah.
One thing always need to remember, do not even take a credit card in the holding company. It should hold the mortgage only. That's all the debt you should have. No credit card, nothing, no borrowings.
Yeah.
Should it have a bank account, like an operating bank account?
Yeah, of course, yeah. It will open up a bank account like an every other corporation or every other individual. The banking doesn't change; it will still remain the same. But the only transaction in the account might be getting rent and paying all relevant expenses.
Yeah. Yeah. You really want to keep that holding company, the transactions limited in that holding company, in the bank account of the holding company.
Yeah.
So should we jump into questions?
Yeah, actually, one common one is, how many real estate assets do you need before you open a holding company? Can it be one property, or does it need to be 10?
It's not about the number of assets. I will always look at the income and the structure of the income. Let us say somebody has income of $30,000, but he owns 6 properties. I might say, don't open a holding company from a tax perspective.
Mm-hmm.
But I might say make a holding company from other perspectives, but not from tax perspective. There could be other person who has a $250,000 in income and he holds only 1 property. And I might say, okay, you not move it into the holding company. So it's a very subjective thing. It will all depends on the structure of the T1 general VC to recommend whether or not a person should move the property into the holding company. But from a risk perspective, I would say move it. Always. Keep yourself safe.
And I'm just looking at some. Let's just jump into the question. Should we just jump into the questions, Kyle?
Yeah, I think that's a good intro.
Yeah.
So Rashi asks, he's got someone that has condos and houses in a holding corporation. How long can they carry forward losses on it?
So it's question from, I'm just trying to find out the question here.
Oh, you go click on question Q&A at the bottom.
No, I do see a lot of questions here, but I'm now trying to find out from whom this was question. Who asked this question?
Rashi. Yeah, I already acknowledged it though, so it may not appear.
Okay, so your question is that how long you can hold the properties in the holding company with losses. Am I right?
Yes, that's correct.
The losses can be carried for an endless period of time.
Yep, easy answer.
So easy answer, but what happens is when you sell the properties, any of the properties with the holding company, the losses will be set off against the capital gains. So you got the tax break when you sell the property. But the larger question is, if you have losses in the holding company, I would fail to understand. The only way you can have a loss in the holding company is if it is not rented.
Mm-hmm.
Not otherwise.
Mm-hmm.
99.99%, I won't see any big losses in the holding company. It will always tend to remain positive.
Mm-hmm.
You might have a cash loss because the mortgage has the principal payment.
Yeah.
That's why there might be a cash loss, but not otherwise.
Yeah,
but
correct.
To answer a simple question, yes, the losses can be carried forward. They can be set off against the future income, if any.
Mm-hmm.
And one more thing.
Yeah.
There's one more thing here. Let us say you have a loss this year, but there were profits in the prior year. You are allowed to carry back your losses.
Yep.
You carry them back, so you'll get a tax refund from behind.
Perfect.
Losses aren't always a bad thing.
I should never have a loss, no matter what. I don't like it.
So this one's not quite tax related, but Alex, maybe you want to just quickly talk on it. Mark asks, what's the feeling or risk of buying pre-build right now? Any concerns about builders getting the money they need to execute projects?
So the answer to this question is, this is when you want to go to established, reputable builders wise. That's the key thing. I've been on calls with builders for the last month wise. That's the most important part. And again, from the building perspective wise, these projects are 5 years out. So from a time frame wise, what we're dealing with now and what's happening in the future wise, this is going to be a blip on the radar compared to the 5-year time frame of these projects wise. So Mark, you'll get I think you'll get a better understanding when we do our weekly when we send out our weekly chat video wise. But that's basically what it is. You just want to make sure you're sticking with reputable builders that projects are approved and they have strong balance sheets.
Just one quick question here,
Yeah.
Alex.
Mhm.
Do you see some builders going south?
No, not the builder. Not the builders going southwise. You will have canceled projects this year. There will be projects that'll be canceled. So those are two separate things. There will be projects that will be canceled. Wise, from my conversations, if you bought a condo in 2017 and that building has not started construction yet, then there is a good chance that project may not get built. That project will get canceled. So that's not a builder going south. That's a project getting canceled. There was recently a builder that did go southwise, but that was through their funding strategies wise, and they were doing things they weren't supposed to. So this is a time when if people have done things in the past that they weren't supposed to, and get their hands caught in a cookie jar, because things have tightened up, then yeah, you could have situations like the Crestford situation that happened recently wise. But other than that, I don't see, as long as people are structured correctly wise and we're doing the things they were supposed to, no, I don't see anyone going southwise. But there will be projects canceled, 100%. That'll happen. And again, if a project gets canceled, you don't lose your money. You just lost the opportunity.
Yeah.
Gain on it. So you haven't lost your deposit. You get your deposit back. We're very well structured in Ontario wise to protect the investor in pre-construction. But you've lost the gain. That's the situation. I do want to jump into this question, even though I don't like answering anonymous questions, but this is actually a really good question. We are planning to move into our rented condo later this year. What steps should we take to make this transaction? How do we come up with the value of our rented property if we plan to use it as our principal residence?
I'm trying to find this question, Alex.
Oh, if you go to the question and answers and you scroll all the way to the top, you'll see the you'll see it right at the top at 1116 is when the question.
1116. Okay. Can we use include one or two incorporated? Talking major. I don't see that question.
If you go all the way to the top, you gotta scroll all the way to the top.
No, I'm there. 1116. I don't see the question there. The only question I can see is, can we include examples where you might have only one or two rental?
You might be in the chat. You might be in the chat. So if you go to the bottom of the screen and you see Q&A, click on that.
Oh, yeah, I see there now. Okay.
Yeah.
Okay, I see. We are planning to move to a condo rate of this year. So what steps we should take to make this transition? How do we come up with the value of the rental property if we want to use it as a principal residence? This is called as a change of use.
Yeah.
Change of use property is the best thing is that you get an appraisal for this purpose.
Yeah.
That's one thing you can do.
Yeah.
But then other thing is that this is an accounting thing now. And don't quote me on this. Let us say you bought a condo about 5 years ago and you want to live in that for the rest of your life. Let's say another 10 years. What I would do is I would go by the simple formula, how many years I lived in that property, which is 10. So I would be allowed a deduction on that principal residence on a factor of 11 over 15. 10 is the number of years you own the property. You always add 1 on top of that, and you divide it by the total number of years you held the property, that is 15, and multiply by the capital gains. That portion would be tax-free. So it means the longer you hold the property for your principal residence, the better it is to keep it this way. But if you're doing it in another way, which is you want to sell it a property after 1 or 2 years, in that case, the best thing is get an appraisal, keep it on your records, because that will be a change of use. In that case, the method of calculation, the taxes will be totally different, because your accountant would have the appraisal and he can do the rest.
And,
based on the appraisal.
and what I want to tell people wise, reach out to your accountant. Get your accountant to help you out with this. I took accounting in university wise. I actually did my co-ops at accounting firms.
Really?
I was studying to become an accountant. The thing is, I hated it. I hated audits. I'm like, I don't want to do this. But guys, sorry, I have my chat screen open. So literally the textbook for the tax course is this thick. It's this thick. The amount of knowledge that's needed, you don't want to do this stuff on your own. Like you don't. So it's good to have it's excellent to have a general knowledge wise. And that's, you can always do things but ultimately anything we recommend here is then take it to your professional wise to help execute on, but at least you have a little bit of knowledge wise and confidence when you're the questions to ask your knowledgeable professional. So I just wanted to add that on. Would you agree, Sanjeev? Don't do this stuff on your own?
Absolutely.
Absolutely insane.
Because if I were to buy real estate, I'll call Alex because he knows what he's doing.
Actually, I'm going to add this. Okay. If you go do it on your own, you're going to save some money in the short term, but then you're going to have to pay more money in the long term for someone to fix the mess you screwed up, or just pay the money now. And then you won't have to pay more money in the future wise to fix the mess. How many messes do you clean up a year, Sanjeev?
I can't count. I can count, but you know what? Sometimes I feel sorry for people. They're so simple little things. All the guy would have done was check one box. It's the only thing which was required. And that wouldn't have even costed any money to anybody.
Yep.
Now I'm cleaning it up. It's a big one. And I do it all the year. Sometimes I feel if they're older couples, I feel bad for them.
Yep. Oh yeah, for sure.
And they only realize those problems when they have no income.
Yeah.
What happened? Why this happened?
Yep.
Great. So let's jump back into the questions.
Yep.
Asks, can I claim entire expenses such as new appliances and renovations in one calendar year of my tax return for that same year?
What's the question time?
11/17.
12/17? No, 11/17.
11/17. The very top.
You can claim the renovation and the new appliances in the same year. That's not a problem. But ideally, if it is a new condo, in that case, the appliances would be capitalized and we will claim as a depreciation on those appliances. We would not claim it as a write-off against repairs and maintenance. Renovation, I'm okay. But if you're replacing an asset, because let us say you already had the appliances, but now you're replacing the appliances, it is subjective. I will write it off. I will. But there's the other side to it. It depends on accountant to accountant, thought to thought. The other might say, no, the conservative policies claim depreciation, that is CCA.
Yeah, capital cost allowance.
Yeah. Either way, you don't lose much. The only thing is that you spread that allowance over a period of 5 years.
Yep. Yeah. And going to it, you may not need all those expenses in the first year. So that
you might not need it in 1 year either.
Exactly. Yeah.
I would say I would look at your tax return and plan it.
Great. Next question is Mark. He lives a significant distance from his condo. So can he claim mileage expenses at 54 cents or 48 cents? And
Yes, he can claim it, but he will have to prove from his log that he really did go to the place.
Yeah.
So just maintain a logbook.
Does he need just the logbook, or does he need to track his gas and car maintenance?
No. I tell you, I have a funny example here. One of my clients gave me a logbook, and on the same date, he was in Montreal because he gave a repair bill from Montreal. So you have to be very careful not to be caught in between. You can claim your mileage. You have to maintain a log. You don't have to really give your expenses there. because it is based on a fundamental rule of thumb by CRA that you can claim by 48 cents or 54 cents, whatever the case might be. That is simple, just claim it. Yes, I would repeat again, logbook is absolutely necessary.
Yeah, yeah. You're not keeping track of the expenses of the vehicle. The government has already done that for you in their calculation.
Yeah.
Okay. I'm gonna answer this quick question. Okay, so we kind of addressed it, but how can we move ownership of a property that is already owned by an individual versus the corporation? You know, you're going to seek your professional. That's a complex answer, but the answer is yes, you can do it. Seek professional help. The next part is financing is difficult in corporations. The answer is no, it's not.
No.
You know, there are some more steps that are involved. That's a misconception out there that you can't get a mortgage if you have something in a holding company. Yes, you can if it's structured the right way.
Mortgage getting in the holding company is much easier as compared to being in personal.
Yeah. Okay. So
to personally guarantee those mortgages?
Excuse me?
Do you need to personally guarantee those mortgages of the
Of course, yes.
On any mortgage, you will need a personal guarantee because the mortgage on any day is based on your personal income, which is the cash flow.
Mm-hmm.
Let us say the rent doesn't come in. Who's going to pitch in the rent during that period? It's you personally then.
Yeah.
So they have to rely on your personal income.
Yeah. You're always going to sign off on them. So that's why you can get incorporation. Now, there is only one situation where you don't own guaranteed personally. If you're taking a commercial mortgage, or even on a residential property, then your liability can be limited. Mm-hmm. Yeah.
In those cases, I've seen your personal guarantee to as low as 0 or maybe 10 or 15%.
So going in, light fixtures, stair railing, new appliances, how are those treated tax-wise? Anything related to the investment property you can write off, Mark.
This is a great question. So if you're moving your property into a holding company, is there land transfer tax?
Oh, I already said that one. They got to seek the professional. They got to seek.
Okay.
That's where I answered. It is completely the way you want to transfer it. Do you want to transfer it as a paper transfer or do you want to transfer it as a legal transfer? For a legal transfer, the lawyer is the best person who will tell you. And I would say in more than 70% of cases, my clients have not paid any tax.
Okay, I'll jump into this one. For pre-construction condos, that's an investment property, intern occupancy fees. I hate when people use it's not a phantom rent, it's an expense. How they come up with occupancy fees, it's the interest only portion on the amount outstanding of the mortgage calculated at prime. It's a maintenance fee and the property tax on the property. That's what it is. Yes, that's tax deductible. If it's rented out during intern occupancy, the rental income is taxable. Are interim occupancy fees deductible? Yes, it's deductible. As mortgage interest, no, you just deduct it as an expense wise. It's an expense on the property. I don't know. I just send it to my accountant and they do it. But ultimately, yes, any expense related to the property it can be written off against any income, and any income coming in on the property has to be taxable. Michael, can you talk about the rule of selling an investment property to buy another similar one where you will not be hit for capital gains? That doesn't exist in Canada. That's called a rollover tax. You can do it in stocks in Canada. In the US, yes, there are rollover taxes in real estate wise, but we don't have that in Canada. Once you sell, you have to pay capital gains.
Let me intervene here.
Yeah.
The rules are different if you're having a property for your business use. Mm-hmm. Always remember that. Mm-hmm. If you have a property for your business use, mm-hmm. you're selling that property and buying a new one, mm-hmm. then in that case, if the whole amount on the sale is invested into the new property, mm-hmm. there is no taxes.
Even in holding companies, or we're just talking about?
In whether personal or in holding company, either way. As long as it is associated with your active business income. Mm-hmm. Because when a property which is held under the holding company, which is being used for the active business,
Yes.
then the income of the holding company is
Oh, okay.
also treated as active business income, not
Okay.
as an investment property there.
Okay. So that's a different case then. So if
No,
I,
I'm just trying to explain because
yeah.
people can be very smart in doing those things. I'm not going to say how and when.
Mhm.
If you have a property which is for business use, sell that property, use the proceeds of that property, buying a new property for the business use, the answer to that question is that capital gains are not taxable in the year you make a sale. But ultimately, when you sell the ultimate property you have, in that year, the total gains will come into play for taxes.
Yeah. Yeah, that makes sense. Okay, someone's asking about the Smith maneuver.
What time it is?
11:20. We're at 11:20.
11:20. It's have to go up. $11:20. I see a question. Sorry to jump off 2 minutes. Did Sanjeev
Oh,
mention?
sorry. Above that.
Oh, yeah.
Yeah.
Okay.
Will he address the Smith maneuver and cash damming?
Will he address the Smith maneuver and cash damming strategies? I'll keep mum here.
There we go.
Fair enough. Kent asks, can you expense a personal management fee on your properties?
I tell you, it's a very dicey thing. There are two parts of the questions here. If the property is being co-owned, let us say you and your wife own it, and you charge a management fee, that's fine. And then that management fee would be taxable, but it doesn't really impact your taxes in a big way, unless and until you're trying to just lower your wife's income and up your income because of the progressive tax rates. Let us say your income is low, your wife's income is high, you want to lower down the rental income from your wife's side, yeah, management fee can come into play. You can write that off, not a problem there. The whole purpose, if somebody is claiming an expense, somebody has to pay taxes on that. As long as you keep on doing that, there's no problem. But I saw a funny thing just Alex yesterday, and I was shocked. A guy was a realtor. He got a commission income, and the accountant claimed the salaries out of the realtor income and put that T4 as a T4 income. I still don't know why. I couldn't find an answer why. But that's some kind of things people do. Why? I don't know.
Yeah, and that's where that's why we do these webinars. So people, not everyone does, not even every professional does it the way that we all think that should be done. So you need to have a little bit of understanding when you're dealing with your professional wise. So that's where you get some understanding wise. So if someone tells you to do things and you go, I don't think so, you know what the best way to do it is. So we answered the management fee. Getting a number of questions on this, but I think, so if we go to 11:20, are you suggesting HELCO interest to be claimed on personal taxes or corporation or both?
We can claim if the property is held under the holding company, I would claim it there. But if the property is held on the personal side, I'll claim it on the personal side.
Now,
there is something more to this, which I cannot say here. Please go to your accountant.
There you go.
Along those lines, Ricky's has used a HELOC to pay the deposit for a pre-construction. So do they expense the interest, or should he add that interest to the average cost basis of the property?
You know what? There is a provision in law which says that any money paid for any investment which is likely to yield some income in future can be a write-off. But it's the way you read it. I have always claimed it.
My line to people has been, I have other rental income, and it's easier for me to claim that against my other rental income. If I didn't have other rental income, I don't know how that would be viewed.
There is a line item there called as a carrying cost within the tax return.
Yeah.
That's where it has to be claimed, as long as we prove that it was an investment made to generate some income in future.
Okay, perfect. There you go. So that is good to know that answer. I am glad I have that answer now. I think that was a great question.
Just for clarity, can you use a home equity line of credit on your principal residence to buy other property investment and expense that tax or expense the interest?
Yeah, that's what I said on the first page.
Yeah.
You can do that.
But that's great clarification, Wes, because I do get that question a lot. Now we have a much firmer answer.
So Hitton feels overwhelmed and he says, what steps should I take to learn and grow about how to set up my properties? What should I be doing to structure myself properly?
Is this Hitton Patel?
Yeah.
Yes.
I would say to grow, I would say the realtor is the best person. To structure, accountant is the best person.
Yeah, and what I'll add, and maybe Sanjeev will say no because that happens when I do these. You don't need to set it all up perfectly today. So if you went and bought a pre-construction condo, and you put your name on it, and you'll always have to put your name on it because the builders want some personal liability on there, but you still have the ability to add a holding company later. Like that is an ability wise. So you don't need to stress yourself out about setting it up perfectly today if you're buying something pre-construction wise, because you do have time to set the structure up after the fact. Correct, Sanjeev?
Yeah, I agree.
Yeah. So you don't need, you have time to investigate that stuff if you're buying pre-construction. Again, if you're buying something resale wise that's closing in 60 days, well then you need to figure that out sooner. There are things you can do, but it's going to be more expensive after the fact. So
Alex, I like to intervene here, which is on the pre-bills.
Mm-hmm.
Let us say you book a condo and there are many people who want to sell it on an assignment.
Yep.
Here's my recommendation for them.
Don't.
Move that into the holding company, move that into a corporation, sell it through the corporation, because income on that will be treated as a business income and you pay a tax of 12.5% only.
There we go. Excellent advice.
That's an active business income. It's not a capital gain.
Yeah, exactly. Good to know. Okay, let's continue going on. When can we start using depreciation any year, even if it is for the first few years we didn't use depreciation?
It's an option.
Yep. Do you recommend to set up a holding company and switch personally owned investment properties to holding company? Okay, this question we've kind of discussed before. If you're switching over, you got to go to your professional wise to learn. You need to have a much longer conversation about, I shouldn't say avoiding, but if land transfer tax is applicable. That's a long conversation. Okay, I think we've handled that. Just pros and cons of owning it individually and corporation, we've handled that. For depreciation of rental property, if we have not depreciated a property, can we start now? We just answered that. Okay, yeah, this is a Sanjeev question from Andres at 11:24 about setting up a family trust. Versus
it's a huge discussion. The answer to it depends upon the family size, the family income, and the number of people within the family. It's a very subjective answer. It is a yes and no both. So I don't think so I'll be able to answer this as it is.
Yeah, that's speak to professional, Sanjeev. And again, everyone, Sanjeev's info will be contained in the email recap that we send everyone. So if you have anything and want to reach out for his services wise, he's available to do that. When would you do the change of use from personal to income producing wise? Again, I would say you got to reach out to the professional for that exact date when it makes sense.
And if you own condos with different family members or other partners, can you roll them into a holding company?
It's a beautiful question. And I love that. It is highly, highly technical. It will all depend how you structure your corporation.
Mhm.
Because remember, as a part of a rollover, there is one key thing. When you roll the property from the personal side into the holding company, the interest in the property cannot change. It has to be the same owners in having share ownership in the ratio they held the property. Let us say, Alex, you and me own a property. I was 75, you were 25.
Yep.
If I was rolling that into the corporation, that corporation has to be 75 and 25.
There we go.
And no, it's another thing here now.
Mhm.
If you own multiple properties, in that case, people generally do is they incorporate their different holding corporations and they transfer their own interest into that holding corporation. So it's a partial transfer. So let us say you had 10 properties with various different people. Kyle had properties with different people. I had different people. Maybe if we had something in common, we will transfer our interest only in those properties into the holding corporation.
And I want to tell people this because I ran into this recently. Wise, what you can do it, but the banks won't let you do it if you intend to use leverage. If you have a property, don't own it in two holding companies. It doesn't work. Banks won't give you a mortgage.
No, bank will not give you.
Yeah, just came across that 2 weeks ago.
No way.
That's if you're two individuals that have your own holding companies and you want to buy the property in your holding companies, you got to go to your professional and set up a new holding company to deal with that. You can't buy it in two holding companies.
It's a very highly technical thing.
Yeah.
Great. The next question is kind of interesting. If you're taking equity out of an existing property, does it make any difference if you're going to use that money to buy an existing property or to buy a new pre-construction condo?
No.
What time is the question?
Oh, 11:30.
11:30 at go up.
Well, yeah, I can see is there any benefit tax-wise?
From a tax perspective, the interest will be a write-off no matter what you buy.
Yeah. Just depends on the deal.
Yeah, no matter what you buy.
Mm-hmm.
Great. Sanjeev, the next question asks, do you work with individuals who have only one or two income properties?
Or with just big landlords? Again, it will depend the kind of income from those properties and their own personal income. Let us say the guy was having $250,000 in income and the income of those properties was $40,000 per annum, net income. I'll recommend a holding company right away.
Mm-hmm.
On the flip side of it, the person is having just $20,000 in income, has $50,000 from the rental income. I won't recommend a holding company at all.
Mm-hmm. Mm-hmm.
But this is from a tax perspective.
Mm-hmm.
Again, risk-wise, the answer will be different.
Oh, I think what his answer is, would you take a client on that has 1 to 2 income properties?
Technically, I don't mind taking the clients.
Mm-hmm.
That's what we like to do.
Yeah. So what the key is, if you're a 1 to 2 landlord, by doing this, you can then grow the portfolio with the strategies to a larger portfolio wise.
Most of my clients who had 0 or no ownership are today owning 10 to 15 each.
Okay.
I wish I was a realtor, Alex. I would have been your competition.
What are the tax implications if I change rental property into principal residence? That is, if I move in down the road. We addressed that earlier.
We spoke about this earlier.
Yeah, we already talked about that. We're going to be going faster through the questions wise because I'd like to wrap this up by 12:30 for everyone. So if we've already answered the question, we'll just quickly go over it. What is the optimal asset amount for a holding company? There is no optimal amount. It's just
usually I don't like to have more than 4 properties in one holding company. Usually.
Okay, so I would say there's not a minimum amount. There's a maximum amount that you want to have in there.
Yeah,
which is
it's an option.
Yeah. So do you recommend setting a holding company to own the properties and a separate operating company to manage? Okay, so there we go. This is.
I agree.
Yeah. So do you recommend setting a holding company to own the properties and a separate operating company and manage the properties and expenses?
If the portfolio is of a decent size.
Mm-hmm. At a certain size point, then yes, the answer is yes, it is a recommendation. Do you have a website where we can get more info about creating a holding company and transferring our personal owned properties? No, because it's going to be a conversation what the best structure is. So that's more of a conversation with a professional wise, not a website solution. Too many variables.
Yeah.
Borg has an interesting question. If you own a house that has a rented basement, can you somehow add the basement rental into a holding company?
No, sir.
No.
You lose the benefit of the principal residence in that case.
If you transfer 4 condos from personal holding company without mortgages and 4 condos with a mortgage, what is the process?
You know what? If you're moving with a mortgage, it means it's a legal transfer.
Yeah.
So technically, then you have to get your lawyer involved here.
Yeah.
But if it is just a paper transfer, then everything stays as it is, only for tax filing changes.
Yeah. So Maria, that goes in. It's speaking with your professional wise and the difference between a paper and the legal transfer and what you actually want to accomplish by this. So I guess the answer is yes, you can do it, but it's going to be a more detailed conversation wise on what you need to do. How does tax work for the foreign investors? That's actually fairly, it's a complicated and easy question at the same time.
It's a very detailed question. It's a detailed answer.
Mm-hmm.
For the foreign investors, is that the taxes work in a total different way. So unfortunately for them, incorporation is not a choice at all.
Mm-hmm.
Not at all. And to file their taxes, they have to file their taxes under section 216, and it is just a short form tax return. They have to report their taxes. There is a tax withholding of 25% on the rental income.
Yep.
And then you file your tax return, and if your expenses are there, then you get a refund back.
And I think there's also a difference if it's a foreign investor or a non-resident.
There's a lot of difference.
There's a lot of difference. So it's very, very, I would say you need to talk to someone because it's a very, very complicated question. But ultimately, there are foreign investors in Canada wise, and yes, you can invest, and then you just build a tax strategy around that. 100% possible. Does a rollover provision apply when you move the units to a holding company, whether it's a paper or legal transfer? What rollover provision?
Yeah, you have to apply. You have to send the application for rollover to CRA under Section 85, regardless whether it's a paper or a legal transfer. Because that will allow you to freeze your taxes. Because the rollover is always done at the purchase price. The rollover is not done at the market price. For example, you bought a property, you bought for $600,000, but over the years it's gone to $1 million. The rollover from the personal side to the holding company will be at $600,000 only, not $1 million. Because if you increase that from 600 to anywhere between $1 million, the difference will be taxable to you personally as capital gains. So this is the most technical part of rollover. That professional should know what he's doing it. It looks to be a very simple form, but it is the most complex form.
Yes. Yeah. Again, you don't want to mess it up.
Yeah.
Rose has, do the shares in a holding company qualify for the capital gain lifetime exemption?
No, because it is not a small business corporation.
Okay. Can you change articles?
Yes.
After? Yes, you can. There you go. So what about a rental company that I renovate to increase the value of it? What about a rental company that I renovate? Oh, probably company's supposed to be condo.
Yeah, it will be added to your cost.
Yeah. Yeah.
The improvement.
How do I transfer funds from an active? This thing's moving.
Active company to holding company to personal in a tax. This is something we have to see the structure of your operating corporation and your holding corporation. Once we see the structure, only then we can advise on this.
Can you mention and comment about the significant costs incurred when transferring real estate asset from personal to corporate, example, land transfer, and how you expense it in the future? Thanks. Again, you know, any rollover from personal to corporate wise, you're going to have to, the situation is going to be different. And you're going to have to talk to directly have a conversation with the professionals on that and what your structure is. I don't think this is applicable, but can the operating company have an HST number where you claim?
No. Technically, what I understand from it is a totally different thing. No, it won't apply because there's no HST on rental property for residential thing.
Okay, I have 4 properties, 2 on my wife's name and 2 on my partnership with a partner. Can they be transferred all?
Answer is no.
No. You're gonna have to do 2, but it's okay having 2 separate holding companies.
Yes, you can have any number of holding companies.
Yeah, there's no limit to the number of holding companies you have. There is an expense to maintain each one, but just looking at that case, because there's different partners and everything, that have 2 holding companies. It's okay.
Yeah, you can have 2, 3, as many numbers you want.
Yeah.
Katie is a small landlord with only 1 rental property. Fairly straightforward. Do you recommend she uses an accountant? And are you taking?
If answer is if you only want to own 1, even in the future, I would just keep on doing by yourself because there will be no tax planning involved.
But Katie, we can grow your portfolio larger if you're still on. I know. Okay. I have 4 condos personally held and being leased. I want to pass these properties. Oh, good. This is great question, Wise. Kyle, why don't you read this to Sanjeev?
Yeah, Sherry asks, I have 4 condos personally held.
This is such a detailed question, such a big question and a very detailed answer. This can be answered when we meet personally because there are a lot of factors involved with this.
So, but I guess if we gave the answer is, yeah, you can, right?
You can.
Yeah, the answer is, yeah, you can, Sherry, but it's a loaded answer.
Yeah.
Great. Jenny asks, can a person have 1 holding company and no operating company?
Operating company is generally for the people who have business income, usually.
Great. Rain asks, could a pre-construction purchase be moved into a holding corporation before the project is completed?
Alex will answer it.
Yeah, generally, yes, not an issue. You provide direction. Your lawyer's going to provide direction to the builder's lawyer on final closing.
Rose asks, when is a good time to buy a multi-residential unit?
Yesterday.
Ricky asks, Alex, you mentioned pre-construction sold in 2017 is going to be prone to cancellation. Why 2017? Why a significant cutoff here?
Key thing. There's an error in that question. It's pre-construction that has not started construction. So that's key. So if you bought it in 2017 and it has not started construction, the reason why it is more prone to cancellation is that their costs have escalated significantly wise. And what they sold, there's a big difference between what they sold the properties for and what their expenses now are. This does not make the builders bad people. These weren't expected expenses wise, and they're not canceling the project to make more money. They legitimately will not be able to get their construction financing to build the project. So if there's no money to build the project can't be built. So that's the issue on those wise. So it's more so if there's anyone to blame on this, it's actually more on the government side, because what happened in 2017 is the government changed the rules. So the builders were playing by a certain set of rules, and then in April 2017, the rules were changed, and they moved the approval process, which was already onerous, to a even more onerous situation-wise. So the approval process extended significantly for builders-wise. So what they expected to be able to get their buildings approved, that process had extended wise, which then extended their time frame for building wise. And then during that time, costs exceeded beyond their expectations wise. And lo and behold, if they can't get their construction financing based on their pro formas, then there's no money for the building to be built. That's why.
Alex, just give me 1 minute.
Yeah. Great. So we have had a lot of people ask for Sanjeev's contact information. We will be distributing it with a copy of the recording after this session to everyone that did attend. So you don't have to worry about getting that. We will distribute it.
Yeah, I can answer. Can you please talk a bit about HST rebates on new construction and the 24K cap? Yeah, you just apply for it and you get the 24K. It's a money in, money out situation wise. So if you paid 24K in on final closing wise, you're going to get that 24K in back. There's a certain threshold of what the price point is wise, and you get the money back. It's a cash flow item. It's money in, money out.
And Margie asks a situation that's happened to a lot of our clients. So what if they changed the use of the property in the past and no appraisal was done? What do I do now?
Yeah, that's easy wise. I've done this for lots of clients where I've went and I've looked at the past sales for the properties, did a letter of opinion to the clients and showed them what the value of the property is. Appraisals can be backdated to, let's say 2015. The appraiser can go and the appraiser can give you a value what the property was in 2015. It's not that hard to find out. So it's not an issue wise. They just backdate the appraisal.
So Eugene asks, do you need 5 full-time active employees to classify corporate income as active income?
I think they got mixed up between the holding company and the operating corporation. Any holding company will always be having an income which is passive. But I have seen people who have multiple properties within a holding company, and there is such a large income, they hire 5 full-time employees. In that case, that passive income becomes an active income. So it really depends upon the size of the portfolio and the income, whether you can have 5 full-time employees or not.
Great. Yes, I use Sanjeev as my accountant.
I will be as well moving forward. I haven't set up a holding company yet because I just have one actual property, but I have many more in the pipeline that I've not taken yet.
Can you speak more about applying for financing in holding company versus? Well, you know what? Here's if you're applying for financing, and you have a holding company, don't walk into the bank. You need to have a mortgage professional that knows what they're doing with that wise. If you just walk into the branch level, they're not used to doing that type of transaction wise. But again, it's really not that hard to get the financing when you have a corporation wise. You just need the right person processing the file that knows how to provide that information to the underwriter.
James is asking, is there a maximum loan to value for holding companies?
No.
80%.
Same. What is personal?
Same.
Karim asks, what repairs need to be capitalized? And once capitalized, can they be amortized? So we've covered this a bit on
I'll add one line here. Any repair which adds to a long-term benefit on the asset and increases the value of the asset, that should be capitalized. A repair which does not add to the value of the asset should not be capitalized. Let us say you're replacing the equipment of the appliances. It doesn't increase your value, so I'll write it off. But you're adding an extra room, extending the size of the property, I'll capitalize it. It all depends, what is the nature of the repair? Is it of capital nature or is it of revenue nature?
Yeah, holding company, it still gets the capital gain. Still capital gain exempt wise, only 50% when you sell. Hit 10, I would say in our email, he's asking more about starting his journey. You can book a consultation with us to make sure you're set up on the right steps. So book a consultation with us and we can go over starting your journey wise. If I sell a rental property and take back a mortgage, does this spread the capital gain over a period of the mortgage? If I sell the rental property and take back a mortgage, oh yes, the answer is that yes, but I'll let Sanjeev jump in.
I'm trying to find a question. Where is that?
Okay, yeah. So the
one,
question
Brenda.
is, I sell the property and I take back a vendor take back mortgage. So
yes, if you take a vendor take back, you can defer your capital gains taxes for a period of 5 years.
Yeah. So the answer is yeah. You can switch your gain over a longer period.
Asks, is rental income considered
active? We're going to have a longer conversation with him.
Okay. Do I need to report to CRA when I've sold my pre-construction assignment?
100%. It's a profit you made. You have to report your profits.
Yeah. Don't. They're going after you. You're on their red flag list. They're looking for those.
Alex, I'm dealing with 10 to 15 files every year on this.
Yeah, the government is not happy with people that do that. Can you refinance the investment property and use that money to purchase a principal home?
Answer is yes and no.
Yeah.
If you're holding the properties in the holding company, then then you have to consult your accountant for that purpose. But if the investment properties are held in your personal name, yes, you can certainly use that money to buy your principal home. No questions asked.
Yep. Okay. Yep. So there we go. So if a tenant market is in surplus, then where is the benefit of buying an investment? So actually, if right now, this has always been the advantage of pre-construction wise. Pre-construction, I'm not concerned about finding a tenant now. I want to find a tenant in the future wise. So what the advantage of buying pre-construction is that I get the property in the future, but also in the future wise, I'm getting the higher rents in the future. So if you're buying an investment now and you're concerned about the property and its vacancy, because there will be vacancies right now, you buy a pre-construction property that'll be done in 3, 4, 5 years, you're getting that higher rent and expected tenant at that future date. James, we can talk more in general about that, about diversifying lenders. Paper transfer wise, again, talk to your accountant. Okay, I do want to, is a holding company income tax the highest rate since it's passive income?
Yes, sir. That's where I said the rate will be almost equal as if you had the marginal tax rate. As when I said it is 53%, but you get the 38% back when you distribute that money as a dividend. So that's how you lower your taxes in future. It's a huge discussion to have.
Yeah. Okay, where are we at now? Okay, we're down to 12. We're down to 12.
We're getting, Alex, how far back can you go claiming the HST rebate on pre-construction?
2 years.
2 years.
And there's no exceptions. If you pass that 2-year mark, it's gone.
We're done. Oh, by the way, Alex, we won 2 files on this. We got the money back.
Past the 2-year mark?
Yeah.
Okay, well then reach out to Sanjeev if after 2 years.
No. We lost as well, but I said we won 2 files.
Oh, you won 2 files, yeah. So most likely it's lost.
Yeah.
So Linda has an interesting question. I'm assuming she's renting out her basement. Do you still pay capital gains on that, or is that then considered full income when you sell your principal residence?
Percentage.
There's a lot of ambiguity on this. CRA in general has not taxed the people if they have been renting their basement.
Okay, there we go.
But I won't say it will remain like this. If the mind changes, I don't know.
Mm-hmm.
Great. So Alan has an interesting one where it looks like he's renovating a previous rental that he's personally going to move into. Is that tax deductible?
Okay, beautiful question and beautiful answer. How do you want me to answer it? If the property is rented, he does the repair and renovation and rents it again, it is deductible.
Correct, yeah.
If he's moving in, unfortunately, certain no. Then it has to be capitalized.
Great. Okay, home stretch. What are the tax implications of purchase a rental property 50-50 with someone, but the property is under other person's name? So I think what they're saying is you buy a property 50-50, but it closes under one person's name.
Technically, yours is a highly technical question that might be considered as an assignment. And if you forego your share, it might be considered as a deemed income. It is a can of worms. It can open up.
Mm-hmm. Mm-hmm.
Would you ask me, will it really open up? 99% no.
Mm-hmm.
I'm not seeing any unique questions. Alex, anything else that you see?
Yeah, actually, and you know what, I was thinking about this. We may do, this is James, can you bring on a lawyer for the next webinar to speak and deal about paper transfer? What do you think, Sanjeev? For the next one, should we bring a lawyer in?
I would say, if you talk to the lawyer, he will always say, do a legal transfer.
Yeah.
If you're talking an accountant, he would say, you know what, there's an option. But there was one question I read. The gentleman asked that, will not it expose us if we do a paper transfer? Yes, it's a risk.
Mm-hmm.
Risk in the sense, you will still be held as if you own the asset in your personal name legally.
Mm-hmm. Mm-hmm.
You will be, let's say there's a lawsuit against you.
Mm-hmm.
You're exposed.
Mm-hmm.
Doing a legal transfer is the best option.
Yeah. And here we go. Again, this is going in, I see Vicky wise. I have a personal property. If I transfer to holding company, am I allowed to transfer my mortgage over to the holding company?
If it's a legal transfer.
Yeah, legal. So that's a difference for everyone wise. And the difference between the paper and the legal transfer wise. If you have a mortgage on the property, you 100% have to do the legal motion. What is your advice for me if I pay down payment of a new property in Calgary for my home equity line of credit? Yeah, Calgary's fine. I have investments in Calgary. Doesn't really impact anything, right, Sanjeev? Same rules apply across Canada.
There's a question at 12:36. Can we have one session on trust? I would say get Arpit involved on this. Yeah.
The form for HST refund wise, again, don't do it yourself. Pay someone to do it. If you want to know who to use, send me an email. Or do you do the HST rebate, Sanjeev?
Yeah, we do a lot.
There you go. Sanjeev can do the rebate. Don't do it yourself. Trust me. If we have holding companies, will the income taxes be done separately from a personal income tax? Yes. I have heard corporations are costly. What are some of the estimates to plan for opening a corporation, yearly T2 filings? Yeah, I think that's what you want to say. What the costs are, Sanjeev?
You know what? But I would say for any corporation, the recurring cost is between $1,500 to $2,500 a year.
Yeah, it's not that bad. Considering how much money you're going to save, it's not that bad of an expense wise, and your stress level is 0. Someone else is handling your problem. Can you hold a session for international investors? Yeah, probably at some point in the future wise, we'll have something targeted to the international side. I have a mixed use property in one company, which is owned by my holding company. How do I transfer funds? Okay. Yeah. So again, anything like that transfer wise, you're going to have to speak with your professional. I think for the most part, I think that covers everything, right guys? For questions?
Yep. That's all I'm seeing.
Hi Alex, I like your background scenery. Is it really CN Tower or is it a painting? It's a picture. I'm sitting in my basement. Okay, I'm gonna end it with that. Well, thanks so much for your time, Sanjeev.
Thank you very much for getting me in.
Yeah,
I'll be glad to answer anybody's questions.
Yeah. So we're gonna, again, everyone that's still on, we're gonna do another one of these next Friday, and I'm really excited for some great conversation. And again, a recording of this will be going out to everyone at the end. You'll be emailed that today or tomorrow wise as well. We'll forward along Sanjeev's contact info if you're interested in his services. So thanks so much, guys, and really appreciate you guys spending time with us. Again, thank you.
Thank you, guys. Stay safe. Enjoy.
Okay,
bye, everyone. Bye.